Confusion. Should I do investment through mutual funds or should I do investment by individual stock picking? This is the confusion which everybody would normally have when they see the differences between mutual fund investing and individual investing. The advantage of individual investing is much higher compared to investing to mutual fund. But however, in case one doesn't have the time and capacity for analyzing stocks and performing valuation methods and key ratio analysis, then mutual fund is the way forward. The same applied to me when I started my journey of investing. I went ahead and started investing through mutual funds, and then slowly as I developed the capability of investing into individual stocks, then I slowly diverted funds into individual stocks, but I kept those mutual funds. So that became my benchmark to compare whether my performance is better or is mutual fund performance better. So accordingly then, you can divert your capital towards mutual funds and towards your individual stock portfolio. So whether it's mutual fund or individual stock picking, both of these require some level of initial effort anyway. Now let me explain, how would you decide which mutual fund is most suitable? When I started investing to mutual fund, I didn't know these aspects. It came on later on that I needed to pay attention to these aspects. I was lucky enough that whatever investments I had done to mutual funds from the beginning did meet those criteria. You can say luck. But then I realized that the three aspects which we need to take care. The first aspect, we need to determine who is a fund manager. Whether that fund manager has a prior level of experience in some previous fund houses or previous mutual funds which he has managed in the past. What are the returns that he has managed to give for those fund houses? So that will guarantee how much returns we can expect from that same fund manager who is managing that new fund which we are going to invest into. So that is one of the first aspect. The second aspect is we need to see the returns over a 10-year period mandatorily. Not 5 years, not 3 years. 10 years. Because within the 10 years, you would have many ups and few downs, of course. You would have at least 2 downs for sure. So we need to see what is the fund performance when there were these ups and downs. Despite all these ups and downs, what is the return it has given over a period of 10 years? And you can be rest assured then that if you keep your investment for the next 10 years, then you can get the same return what the fund is giving for a period of historical 10 years. That was the second point. The third point is to identify what is the asset under management. The higher the asset under management, the lower your expense ratio which you're going to pay every year on year. So there are mutual fund houses which charge almost 2 to 2.5% expense ratio over and above your transaction fees if you're doing SIP, and over and above your exit load as well. But considering that you are not exiting and you're going to stay invested for a period of 10 years at least, then you are going to pay expense ratio year on year which is going to range from 2 to 2.5%. But there are mutual funds which charge around 1 to 1.5% year on year as well, because the asset under management is very high. So this helps them reduce the expense ratio for the individual investor. So these are the top 3 things which you need to look into before you start picking your mutual fund. Of course, the other aspect is whether you want to go for equity fund or whether you want to go to debt fund or whether you want to go for balance fund, whether you want to go for pharma, FMCG. There is plethora of mutual funds. But however, the best is to pick 2 or 3 flavors of mutual fund and go ahead and start investing into mutual fund before you develop your knowledge into individual stock picking. So that is what I wanted to share. I hope the confusion is dur ho gaya. So happy investing, and please subscribe before you forget, so that I'm going to share many more videos which is going to improve your financial literacy. See you until then. Bye.